questions. So
sounds like a long
should have
time.
talked longer. So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. As I mentioned, there really isn't a risk-free path now, since it appears that inflation is running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So those two states of affairs for our two goal variables, call for different monetary policy responses. So as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment, employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is 50,000 plus or minus, something like that. And that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal, and that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly, and the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace, although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So If you go back to when I was in college, that part would have taken, weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly, but then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at, is better used as a supplement for the underlying governmental data, which is the gold standard. And it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes, less so in inflation space and in economic activity space. And also they're just, there are different private data providers use different universes and different levels of rigor in their data analysis. So, we're looking at lots of things, and, we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report. And we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price